A year ago, after 20 years of work, we wanted to ask ourselves, so what is the record look like? How much have we made progress? And we were very lucky to be joined by Laurie Fitzjohn-Sykes, somebody who has worked before for many years in the city as an analyst, who, as I like to say, knows where some of the bodies are buried. A former sell-side analyst, as I said. And Laurie is going to talk tonight about what's wrong, what's next for UK business. Laurie Fitzjohn-Sykes.
Thank you, Mark. So as Mark said, we started by looking backwards 20 years at how much progress we've made. And despite the considerable progress in many areas, from governance to acknowledging climate change to diversity, when we look at the macro data outcomes to key stakeholder groups, it unfortunately paints a bit of a bleak picture. And it starts with low levels of investment. Now, this is for investment in fixed assets, so equipment, machines. And of course, this is partly because the UK has shifted away from manufacturing towards services more than other economies. And therefore, it's particularly worrying that investment in R&D is also low and falling versus other economies. And this is particularly stark when we look at the sharp rises for Asian countries. And it's hard to see how the UK can lead in high-tech industries and knowledge industries if we're not investing in R&D. And this has been partly caused by increasing cash returns to shareholders, which this chart shows as a proportion of corporate GDP. And alongside this low level of investment, we also see low employee engagement. Too often, employees are treated as assets to be sweated, not people to be nurtured. One survey highlighted here shows less than half of people likely to recommend their employer to friends or family. And when we combine this with a low investment, it's not a surprise that productivity is also low, being 15% below the G7 average. And this in turn is contributing to falling real wage growth that's fallen in every decade since the 70s and 80s. And this picture would look even worse if we looked at lower income groups. For over this period, inequality has also risen. And this is fueling a disenfranchisement of the status quo with the establishment, which is fueling the rise of support for perhaps political extremes. People have in reality, well-founded sense that the system isn't working for them. And then when you combine this with recurring corporate scandals, we no surprise get low public trust in business, which in the end then leads to knee-jerk regulation, which in the end isn't good for business. But the irony is, amongst all of this increased focus on shareholders, increased focus on cash returns to shareholders, is that returns to shareholders have actually been quite poor. The 20-year real return on UK equities is now the same as government bonds. The only other period this was the case was the Great Depression. Now, it's not a great endorsement for the current business approach if you get the same return off a fixed coupon government security as you get off the residual value creation. And for us, these problems are very much connected. But too often they're dealt with as separation. People talk about productivity or trust or low investment, but for us they're connected by the approach companies take. Because we believe that companies succeed when all their stakeholders succeed, when they have happy employees, satisfied customers, stable suppliers, long-term committed shareholders, and a trusting public. And therefore it's no surprise that all these indicators are going the wrong direction together, because they're bound up by the approach our companies take. Too often at the moment, companies focus on short-term financial outcomes, cash returns to shareholders. In short, we would say putting shareholders first has actually been self-defeating for both shareholders and society. But this isn't just a problem for companies and their stakeholders. This is also a problem for our economy. Because over the last few decades, companies have actually been significant net savers in our economy, and to an increasing extent. Until in the last year we have data, which is 2013, UK companies saved £100 billion, or 7% of GDP, before dividends and buybacks. And this is a problem because in an economy cannot be an aggregate net saver, because income must equal spending, but they are two sides of the same transaction. And therefore, the addition of net saving borrowing for the sectors of households, companies, government, and rest of the world must equal zero. This is a truism that holds for all economies. And so at any one point in time in this chart, the four lines you see there add up to zero. Now, as you would expect, households are net savers. People want to save for the future, they want to save for their pension. But we would then expect companies to be borrowers, to be investing that money, to be the conduits of investment for the savings of households. But as we've seen, companies are now net savers, and to an increasing extent. And then alongside this, for the UK particularly, the rest of the world is also a significant net saver, but we run a very significant current account deficit, importing far more than we export. And therefore, over the last few decades, the government has, in effect, had to act as the spender of last resort, borrowing money to offset the savings of the other three sectors. And we see the impact in government policy. For over the last few decades, the government hasn't done cyclical demand management in a textbook sense of boosting demand in recessions and then pulling back. It's actually consistent boosted demand to offset that savings. It's run consistent budget deficits to an increasing degree. It's cut interest rates. It's encouraged credit creation, both indirectly and directly with quantitative easing. And yet, despite this, despite the fact the government has now in effect put its foot back to the floor on the accelerator, the economy is stalling. And entering the next recession, there's a real risk that we may have few policy levers left to pull to get the economy going again. And people are acknowledging this. People are talking about helicopter money as a real possibility. Or some countries are playing with the idea of negative interest rates. But for us, the underlying cause of this is significant net savings by companies. It's companies that in aggregate are not taking risks, are not investing, and therefore the real solution to deficit reduction, yes, cutting public spending is important, but alongside that, critical is to get companies spending again and get them taking risks. And a story which for me captures this is the UK house builders. Now we have a well-acknowledged housing shortage in this country, and yet last year the three largest UK house builders returned £840 million to shareholders, and that's despite running 25 to 30% returns on equity. And you just sort of think, we've got a problem. If our largest companies aren't undertaking profitable investments to tackle a societal problem, that's a gross misallocation of capital, driven by the misguided desire that you should return cash to shareholders irrespective of investment opportunities. So after painting that bit of a bleak picture at the start of our research project on, we moved on to looking at, well, has the approach that was first put forward 20 years ago worked where it's been adopted? And here we found a much more positive picture. We would argue that the approach has not only stood the test of time, but the evidence has continued to mount and it's increasingly relevant for a changing world. But this is an approach which recognises that humans are emotional beings, not calculating machines. And because of that, they have a desire for purpose and autonomy, not just for financial incentives. It recognises that successful businesses start with a focus on happy employees, satisfied customers, stable suppliers. The shareholder returns are the end result, not the starting aim. And that to achieve that, you often need a long-term approach, which inevitably involves risk through placing trust in relationships and having the conviction to carry out investment decisions for which you cannot foresee all consequences or measure all possibilities. And then in turn, that is enabled by having a clear purpose for why you exist and a set of values that help guide your behaviours. And in our report, we collect all the evidence together for why we think this approach works. And then, so please look at the report if you want to see all the details. But in addition to that, there's also an increasing number of companies that live and breathe these principles day to day. Companies like JCB, which have invested long term to buck the trend of declining UK manufacturing, or Unipart, with collaborative supplier relationships and an intense focus on culture. Or even companies like Admiral Insurance, which yes, are quite traditional, FTSE 100 insurance, but it has a focus on happy employees. It has what it calls a Ministry of Fun that organises fun events in the office. And as a result of that, it's the only FTSE 100 company in the 30 Great Places to Work Index. And that's just a brilliant example, I think, of a traditional business that by focusing on happy employees as a starting point, delivers brilliant financial performance. Or other examples like Adlands, with their focus on sustainability that helps create a culture, create a brand, and also helps deliver cost savings. Or even examples like Google, which yes, aren't great in their tax affairs, not very responsible, but in many other ways Google represents these principles. It looks after its employees, it has a clear purpose, it invests long term, it takes risks. But of course, this approach isn't something that we dreamt up. It was first put forward by 25 senior business leaders in the 90s, and it very much still today remains grounded in the practical experience of our community, all of you. So I'd just like now to show two clips of two businesses that we think exemplify this approach. Firstly, John Neal, the CEO of Unipart, and secondly, Peter Taylor, the CEO of TTP.
would you say the Unipart way is?
It's extremely difficult to explain the Unipart way in a soundbite. And that's part of the problem with our Western culture is everybody saying, quick, tell me the 3 things I need to do to be a world-class business. It's like saying, tell me the 3 things I need to do to be able to play Beethoven's Ninth at the Albert Hall. Well, sorry, there aren't just 3 things you have to do. It's painful, hard work. You have to have a comprehensive philosophy. You have to have a world-class body of knowledge. You've got to be able to run your business with a guiding set of principles which resonate with people at every level. And you have to persevere and learn and study and work very hard.
If you can wave a magic wand and change anything about the UK corporate landscape or business in general, what would you change if you had that power?
I think business would be more effective and comfortable if more companies follow the tomorrow's company approach. But seriously, what I've seen over the years is companies trying to contract out of risk, motivate companies by fear, by placing contracts on us that where we go out of business if something goes wrong, and that's all part of the diminishing role of relationships and increasing role of transactions and contracts and so on. And I think that this trying to avoid failure, trying to avoid risk, trying to avoid responsibility isn't helpful. And I think it would be useful to see changes in that.
Please see our website for the full versions of those interviews. But importantly, this approach is about long-term value creation in business. For too often, this agenda sometimes gets focused on risk mitigation, or in the worst cases, turns into a box-ticking exercise. Sometimes, perhaps, it ends up being a siloed ESG team in an investment fund, or a siloed CSR or compliance function not directly connected into a business unit head. Or perhaps it gets focused on very worthwhile but relatively small actions at the periphery of company activity. When for us, it is very much about long-term value creation, integrating the core business and investment decisions. It's about having a purpose that drives your capital allocation decision, such that businesses invest to tackle societal problems, and through that inspire employees, customers, and ultimately the public. And perhaps let's just go back to the house builders for a second, and let's imagine that rather than returning £840 million to shareholders, the CEOs of the 3 largest house builders had stood up and said to the government, if you do this, if you enact this set of policies, free up this amount of land, we will commit this much capital to build this amount of homes, so together we will solve the housing crisis. And through doing that, they would help deliver returns to shareholders by deploying capital at a decent return. They would help gain the public's trust through solving a societal problem, and ultimately probably end up with more favourable regulation through gaining the government's trust. And then for us, this is very much an approach which is core value creation, and which creates more value for shareholders and society. So hopefully we've convinced you that business as usual isn't working as well as it could, and also that there is an alternative with mounting evidence and increasing relevance for a changing world. But how do we get there? How do we encourage more companies to adopt this approach? Well, firstly, we'd say we need to celebrate the examples of success. Too often the press focuses on corporate scandals, and many of the great examples which we highlight in our report aren't given enough coverage. So we first of all want to do that. But alongside the carrot, perhaps we need a bit of a stick, and therefore we need to challenge industries and companies on why they aren't investing, like the house builders. And we as Tomorrow's Company want to do that in terms of challenging industries, but then also bringing the key stakeholders together across the investment chain and saying, what would it take to overcome these barriers and get businesses taking risks and investing again? But we also need supportive ownership and governance structures to be critical to enable this sort of leadership. And of course, the governance work and investment chain is a very complex world with many biases and obstacles in its place. And in the report, we highlight a whole number of areas where we could enact change. Because in the end, there's no silver bullet which is going to solve short-termism or the barriers in the investment chain. It's a whole series of small tweaks through the chain which added up would compound to have a much bigger impact. But I want to highlight a few which I think are the most interesting to highlight today. Firstly, in the governance realm, one of the key things from the report is that often some of the best examples are outside the listed sector space. and therefore we think we need to encourage a greater diversity of corporate forms so that all businesses don't see the end game being an IPO or a trade sale. And then in listed company boardrooms, we think there's a risk that over the last few years, with reforms typically following scandals, our governance system has become too focused on trying to stop those scandals happening again. So we're too focused on value protection, not value creation, on risk mitigation, not entrepreneurial leadership and risk taking. And therefore we want to ask the question, does a governance system work if it prevents one Enron, but in the process prevents 5 Googles? And we'll be looking at this question through our Good Governance Forum through the rest of this year. So let us know if you'd like to be involved with that. Then in the investment chain, there's been some good work on the stewardship code, which tomorrow's company played its part in instigating, but perhaps it set a slightly low bar with everyone signing up and perhaps it not having quite the impact as was expected. And therefore we need to work to help asset owners recognise and reward the investment managers that are truly taking stewardship to being core to value creation, that are taking stewardship to encompass all the areas of value creation and are really integrating the ESG team and the investment fund team. And therefore we're bringing together a group of asset managers, asset owners across the chain to look at how can we increase that reward and recognition to encourage stewardship. But alongside this, we need to try and improve the quality of the dialogue with the financial markets. Too often it's perhaps a bit too much noise and not enough in-depth analysis. And therefore one area could be to reform sell-side research, my old profession. And I think that, and we've got a report coming out on that in late June on the possible ways in which we could reform sell-side to shift the focus onto the broader and longer-term drivers of value. And then go to the top of the investment chain. We need asset owners to have issue longer-term mandates to asset managers, so they can take a longer-term view. We had a round table on this a few weeks ago. One of the things that came up was that within the government regulations, there's a maximum 1-month termination clause in local government pension scheme mandates, which is incredible. You can't have a longer than 1-month mandate when you're mandating to asset managers. But if you gave the money to a private equity house, it'd be locked up for 80 years. And it just seems totally farcical. So I think there's some easy changes that we could do there to help that. But in addition to that, we need to also try and shift the debate for asset owners to not just think about allocating capital in terms of liability matching or regulatory requirements, but also in terms of what are the capital needs of the economy and society. And I think this could be quite a critical shift. And to help do this, we want to build a capital allocation map of the UK so we can match up and show where is capital currently flowing and where is it currently needed and where are the gaps, and therefore to challenge asset owners to say, how are you going to help solve this? The government also has a role to play. Many of the challenges in our report are for business leaders and are for voluntary action, because that is core to tomorrow's company's belief, is that change is often best instigated by business, not being driven by government. But government has a role to play here. We highlight a number of areas in the report, but a few just to highlight. Changing procurement criteria so they're not purely focused on cost. We had one discussion where business leaders sort of half-jokingly said were commenting that government thinks they've embraced the business approach by purely focusing on cost. But in the business world, you never do that. There's a whole load of other factors you look at when you're deciding which partners to work with. And therefore the government needs to move away from purely deciding on a cost basis. And then also credit creation. So since the financial crisis, bank lending to businesses has actually fallen while lending to mortgages has increased. There's a number of reasons why this could be, from risk weightings on assets of banks, and I think the government should look at how it can encourage more credit creation to businesses. So hopefully we've convinced you that business as usual isn't working for either shareholders, society, or critically the economy, and that there is a different approach with mounting evidence with a focus on purpose, values, relationships in the long term. And critical to the point we're making here, I think the really new point, is the need for risk taking. The fact that companies are currently saving £100 billion, and we've got to get them spending that. We've got to get them taking risks again. And to get them taking risks, critical to taking risk is to have a purpose you're trying to solve. And to try and enable that, there's a number of changes we can make through the investment chain and government structures to encourage that. So we would, in short, conclude that 20 years on, the tomorrow's company message is more urgent than ever, and we look forward to working with all of you, our community, in taking it forwards.